Hello everyone, we are students of President University Batch 2024 Class 2 Accounting, and now we are assigned to present and explain about our material financial management. But first, let me introduce our member group. My name is Julie Vierot and Siti Rama. Okay, we go to the first question about financial management fundamentals. What is the primary objective of financial management and how does it influence decision making in a company? Provide an example to support your explanation. So the answer is the main goal of financial management is to increase the company's value for its shareholder. This is done by making smart financial decisions such as investing in profitability projects, reducing risk, and controlling cost. For the example, a company has two investment options. It will choose the one that gives highest profit. Well, financial management focuses on three main decisions. The first decision is investment. Investment is selecting profitable projects while considering risk and return. Financing decision is determining the most efficient funding source between equity and debt. And the last is dividend decision is establishing policies on profit distribution to shareholders. The second question of section number 1 is about time value of money. Explain the concept of the time value of money and its importance in financial decision making, and how does TVM affect investment and financing decision. Before we go directly to the answer, we must know what is TVM means. So, TVM means that money today is the worth more than the same amount in the future, because money can be invested to earn interest. It's important in financial decision making is because your money can be invested and generate profit, or for example, interest. And for the inflation, prices keep rising, so your money may not be able to buy as much as you can now in the future. So the conclusion is we can see there is some key factor that affecting TVM. The first is investment potential, the second is inflation, and the last is uncertainty risk. Okay, there is 2 points right here that is impact on TVM. The first impact on investment is companies prefer projects that provide higher future returns. And the second impact on financing is borrowers consider interest rate to choose the best loan option, which means borrowers consider interest rate and repayment periods to minimize interest cost. I give you an example right here. You can see if you have $1,000 today and invest it at 5% annual interest rate, it will grow to $1,050 in 1 year, making it more valuable than receiving $1,000 a year later. And the third question is about capital budgeting techniques. Compare and contrast net present value and internal rate of return as capital budgeting technique. Which one is more reliable for decision making and why? Before we comparing between net present value and internal rate of return, we must know the definition of each section, right? So, we go to the first section is net present value. Net present value means measures the difference between the present value of cash inflow and outflows. A positive NPV means the project is profitable. Besides that, internal rate of return is the discount rate at which NPV equals 0. It shows the expected return of a project. So the conclusion is, for NPV, a positive NPV indicates a profitable project, and internal rate return is the discount rate where NPV equals 0. And now the question is, which one is the better? So, NPV is more reliable. Why? Because it gives a clear profit value, while EIR can sometimes give misleading results if cash flows are irregular. So NPV provides a clear dollar value where IR only gives a percentage that may be misleading for projects with fluctuating cash flow. So the more reliable one is NPV. And the question number 4 on section 1 is about financial ratio analysis. We're gonna do a calculating right here. So the question is, a company has current asset of $250,000. So the A is calculate the current ratio and interpret the result. And B is, if the company has an inventory of $100,000, calculate the quick ratio and explain its significance. So we already received the amount of current asset and current liabilities and also inventories right here. You can see. We do the section A first, calculating current ratio. As we know that the current ratio have the formula. So the formula is current asset divided by current liabilities. And this is the result that we have gotten. The result is 2.0. Based on the result is 2.0, it means that the company has twice the current asset compared to its liability, reflecting strong liquidity. And the section B is calculating quick ratio. As we know, the formula of quick ratio is current asset minus inventory divided by current liabilities. From that formula, you can compute the amount of current asset, current liabilities, and inventory from the left side. And you will get the result of 1.6. So, 1.6 indicates that the company can still meet its short-term liabilities without selling inventory.
In this question, we are asked to calculate the expected return of a stock using the capital asset pricing model. We are given the following information: risk-free rate 4%, market return 10%, beta of the stock 1.5. Using the capital asset pricing model formula, we will determine the expected return of this stock based on in systematic risk. Now, let's move on the calculating using the capital asset pricing model formula. For the calculating expected return, we can see the formula that is given below. 4% plus 0.5 times 10% minus 4%. 4% plus 1.5 times 6%, and after that we got the result from 4% plus 9% equals to 13%. The question section 2. Short-term financing decision needs 100,000 in short financing to cover operational costs. The company has two options. First, bank loan, interest rate of 12% per annum, and factoring, immediately cash at 5% discount on total receivable, equivalent to 100,000 in receivable. Requirement: calculate the cost of financing for each option and based on financial consideration, which option is preferable. Justify your decision with calculation and reasoning. The answer of cost of financial calculation. Option 1, bank loan. Interest cost 12% times 100,000 equals to 12,000. The company must pay 12,000 in interest. Option 2, factoring. Factoring cost 5% equals 100,000 equals to 5,000. The company received only 95,000, so the cost is 5,000. Which option is better? Factoring is cheaper, 5,000 versus 12,000. So it is a better financial choice if the company can work with less cash. But if the company needs the full 100,000, the bank loan might be better even though it costs more. The conclusion is factoring is the better choice based on costs, but the final decision depends of the company's can needs. If only considering the cost, factoring is more profitable because it's lower cost. However, if the company want to keep control over receivable and have flexibility in payment, bank loans may be a better option. That is from us. Thanks for your time.